In 2008, the global economy came to a screeching halt. Millions lost their jobs, homes, and savings as the Great Recession took hold. For many, it was a wake-up call about the fragility of financial stability and the importance of preparation. Hi everyone! Today we'll unpack the story of the Great Recession, exploring its causes, its impact, and most importantly, the lessons it holds for surviving future financial crises. By the end of this video, you'll have actionable advice on how to safeguard your financial health and navigate turbulent times. Let's dive in. The Great Recession was the most severe economic downturn since the Great Depression of the 1930s. It officially began in December 2007 and lasted until June 2009, though its ripple effects were felt for years. The crisis was triggered by the collapse of the U.S. housing market, fueled by risky lending practices and an over-reliance on mortgage-backed securities. When housing prices plummeted, financial institutions holding these securities faced massive losses, leading to a cascade of bankruptcies and bailouts. At its peak, the recession caused the U.S. unemployment rate to soar to 10%, with over 8.7 million jobs lost. The stock market plunged, wiping out trillions of dollars in wealth. Families struggled to make ends meet as home foreclosures reached record levels. Small businesses shuttered, and entire industries like construction and manufacturing experienced sharp declines. The recession wasn't just an economic crisis, it was a human one, leaving lasting scars on individuals and communities. Beyond the US, the recession sent shockwaves across the globe. Countries reliant on exports to the US, such as China and Germany, faced reduced demand. Europe's debt crisis worsened as countries like Greece and Spain struggled with rising deficits and unemployment. Developing nations faced capital outflows and declining foreign investments, underscoring the interconnectedness of the global economy. This widespread impact highlighted the vulnerabilities within financial systems and the need for coordinated international responses. The economic slowdown also reshaped industries. Automakers like General Motors and Chrysler teetered on the edge of bankruptcy, prompting government bailouts to preserve jobs and stabilize markets. Retailers closed stores en masse, unable to withstand declining consumer spending. In the financial sector, once mighty institutions like Bear Stearns and Lehman Brothers collapsed, triggering panic and a crisis of confidence that reverberated worldwide. To understand the Great Recession, we need to examine the events leading up to it. In the early 2000s, low interest rates and lax lending standards created a housing boom. Banks and mortgage lenders began offering subprime loans to borrowers with poor credit histories, often without verifying income or employment. These loans were then bundled into mortgage-backed securities and sold to investors, who were lured by the promise of high returns. Wall Street played a significant role in fueling the crisis. Financial institutions created complex derivatives like collateralized debt obligations, CDOs, that mask the true risk of the underlying assets. Ratings agencies, incentivized by fees, gave these securities top-tier ratings, encouraging widespread investment. Meanwhile, the Federal Reserve's policies and regulatory gaps allowed the housing bubble to grow unchecked. By 2007, cracks in the system began to appear. Borrowers defaulted on their loans as adjustable-rate mortgages reset to higher payments. The housing market, once seen as an endless source of wealth, began to decline. Financial institutions, heavily invested in mortgage-backed securities, faced mounting losses. The collapse of Lehman Brothers in September 2008 was the tipping point, triggering a global financial panic. Governments around the world scrambled to stabilize their economies. In the U.S., the Troubled Asset Relief Program, TARP, provided $700 billion to bail out banks and other financial institutions. Central banks slashed interest rates and implemented quantitative easing to inject liquidity into the market. While these measures helped prevent a complete collapse, the recovery was slow and uneven, with many families and businesses continuing to struggle for years. The failure of regulatory oversight also came under scrutiny. The Securities and Exchange Commission, SEC, was criticized for failing to identify and mitigate the systemic risks posed by subprime lending and derivatives trading. Calls for reform grew louder, leading to significant changes in how financial institutions were monitored and regulated. The Great Recession wasn't just about numbers and policies, it was about people. Millions of families lost their homes to foreclosure, their savings to stock market losses, and their livelihoods to layoffs. For many, the recession shattered the illusion of financial security, revealing just how vulnerable they were to economic shocks. Middle-class families were hit particularly hard. Years of stagnant wages and rising living costs had already strained household budgets. The recession wiped out wealth accumulated through home equity and retirement savings, forcing families to delay major life events like buying a home, having children, or retiring. The psychological toll was immense, with increased rates of depression, anxiety, and even suicide linked to financial stress. Low-income communities fared even worse, as the lack of financial buffers made them more susceptible to the crisis impacts. Many of these communities saw generational wealth wiped out, exacerbating cycles of poverty. Cities with high foreclosure rates saw neighborhoods deteriorate as vacant homes attracted crime and reduced property values. Small businesses, the backbone of local economies, struggled to survive as consumer spending dried up. The recovery efforts, while necessary, often bypassed the most vulnerable, exacerbating income inequality and leaving many feeling left behind. Educational and career aspirations were also affected. Recent graduates entered one of the toughest job markets in decades, forcing many to take on lower-paying jobs or delay their entry into the workforce. This scarring effect had long-term consequences, as lower initial earnings can impact lifetime income and career trajectories. Entire generations were left grappling with the consequences of starting their financial journeys during an economic downturn. The Great Recession taught us invaluable lessons about financial resilience. Here are actionable steps to prepare for and navigate future crises. Build an emergency fund. Having 3 to 6 months' worth of living expenses saved can provide a critical safety net during times of uncertainty. This fund should be easily accessible, such as in a high-yield savings account. For those with dependents or in high-risk industries, aiming for a larger buffer, such as 12 months, may be prudent. Diversify your investments. Avoid putting all your eggs in one basket. Spread your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. Consider geographic diversification as well, investing in international markets to hedge against domestic downturns. Live below your means. Avoid lifestyle inflation, even during good times. Maintaining a modest lifestyle allows you to save more and reduce financial stress during downturns. Track expenses and identify areas where you can cut back without sacrificing quality of life. Pay down debt. High-interest debt, such as credit card balances, can become unmanageable during a crisis. Focus on reducing debt to improve your financial flexibility. Consider the snowball or avalanche method to systematically tackle outstanding balances. Stay informed. Understanding the economic landscape can help you make better financial decisions. Follow trusted financial news sources and consider consulting a financial advisor. Tools like economic calendars and market analysis apps can provide timely insights. Be adaptable. In a crisis, flexibility is key. Be willing to pivot, whether it's by taking on a side hustle, relocating for work, or cutting discretionary spending. Flexibility in career skills, such as learning new technologies or certifications, can also improve job security. While the Great Recession was devastating, it also sparked important reforms. The Dodd-Frank Act introduced stricter regulations for financial institutions, aimed at preventing another systemic collapse. Consumer protections, such as the creation of the Consumer Financial Protection Bureau, CFPB, sought to curb predatory lending practices. The rise of fintech tools has made managing money more accessible, empowering people to take control of their finances with apps that track spending, savings, and investments. The lessons of the Great Recession remain relevant today. Economic cycles are inevitable, but preparation and resilience can make all the difference. By adopting sound financial habits and staying vigilant, we can weather future storms and emerge stronger. Education is key. Understanding how markets function, the role of monetary policy, and the importance of diversification can provide a solid foundation for long-term financial stability. The Great Recession was a harsh reminder of life's uncertainties, but it also showed us the power of perseverance and adaptability. By learning from the past, we can build a more secure financial future for ourselves and our communities. Thanks for watching, everyone. Let me know in the comments how the Great Recession impacted you or someone you know. Don't forget to like, subscribe, and hit the notification bell for more insights on navigating life's challenges. See you in the next video.